Hello, and welcome to another episode of Full Court Finance here at Zacks. I'm your host, Ben Rains. And today we're taking a look at two housing-related stocks to consider buying at a rather substantial discount at the moment. But before we get into everything, remember to subscribe and leave a review wherever you listen to your podcast. And make sure to check out our new Zacks.com/promo page for a look at our services, portfolios, and more. So before we jump into these two housing-related stocks, it's certainly worth going over what's going on in the broader market as we head into the second quarter, as we get into the last week of March. So the S&P 500 has now surged roughly 9% in the last 2 weeks. Obviously, it's down a little bit Monday morning, but at the close on Friday, it was up about 9% in 2 weeks, to put it around 6% below its records. So big bounce back in the last 2 weeks. The benchmark is now back above its 200-day moving average as the bulls continue to buy a lot of beaten down stocks amid the ongoing Russian invasion of Ukraine. Meanwhile, the tech-heavy NASDAQ has ripped off a nearly 13% climb since those March 14 lows, also now back above its 200-day moving average, driven by big gains from all the usual suspects of the big technology players. Wall Street is also apparently pleased enough with the Fed's updated rate hike outlook, having accepted the official end of the super easy money days. So yields on the 10-year U.S. Treasury are up near their 3-year highs. They're at about 2.5%, and the rising interest rate environment should make stocks less attractive. Still, that said, real yields are deeply negative when you're factoring in almost 8% inflation. So investing in bonds or hoarding cash might not be as prudent as some might assume, with interest rates still historically low and inflation at 40-year highs. So even though they're back up from their COVID lows, they're still very low historically, and we have inflation at 40-year highs. So this backdrop could leave Wall Street possibly chasing returns in equities for the foreseeable future. That said, obviously volatility could likely remain, and it could remain really elevated, giving rising prices across the economy, from energy prices to really everything else. If you've been buying anything, it's more expensive than it has been. Coupled with the changing rate environment and that geopolitical chaos and unknowns, that as it goes longer and longer in Ukraine, there's more and more worries about what's to come next. So obviously there's still going to be volatility, but it's nice to see that the bulls have jumped back in. And even though we've seen some revisions turn in the wrong direction for Q1 in terms of S&P 500 earnings and margins, if we look out to the rest of 2022 and 2023, it's still broadly positive and growing both this year and next year for earnings, revenues, and margins above a really solid year in 2021. So we're going to look at the first of these two housing-related stocks to consider buying rather attractive levels. And the first one of those companies is Lowe's, which trades under the ticker LOW. Lowe's is a home improvement giant that mostly operates in the United States and Canada. The company and its various related operations service roughly 20 to 100 home improvement and hardware stores around the country, and as I said, in Canada mostly. The company sells everything really from, I'm assuming people have been in either a Home Depot or a Lowe's, but sell everything from light bulbs to wood to redo a deck, and it's everything under the sun for anything involving your home or apartment or outdoor gardening area, anything like that. So the company has benefited for years really for growth within the broader do-it-yourself home improvement market and growth within the professional sector as well. So the company's posted year-over-year revenue growth every year since 2010. This includes a whopping 24% growth in 2020 that saw a jump from $72 billion all the way up to $90 billion. It then posted another 7.5% top-line growth last year as the pandemic housing market continued to boom, as more people are just spending money on home improvement projects, wanting to care more about their living space as they dealt with moves and all of that. So the last 2 years have been a really big stretch for Lowe's and many of these broader home improvement and housing stocks. Meanwhile, the company saw its adjusted earnings soar 55% last year, and the company's FY 2022 and 2023 earnings outlook has improved since its Q4 release in late February. This positivity helps it land a Zacks rank number 2 buy right now. The company also provided rather upbeat guidance overall for 2022, despite rising costs and supply chain issues. Uh, and Wall Street really appeared to cheer that at the moment. The retailer's ability to manage costs and all the rising prices, as we said. So, providing a strong outlook amid the headwinds is a good sign. So, with this in mind, we're calling for another 2% revenue growth on top of what we said is back-to-back years of huge growth, and then a decade straight of top-line growth. And then we're calling for another 2.2% growth in 2023. So back-to-back years of more stabilized growth, but still growing on top of what has been 2 years of huge growth. And then on the bottom line, we're calling for another 11% growth this year and about 10.3% growth in 2023. So stellar growth, really double-digit bottom line growth on top of what was 50% growth last year. And then the company has a pretty strong history of earnings beats as well. It's beat by an average of 13% in the trailing 4 periods. And then overall, obviously, some of these stocks have been hit a little bit hard because despite the rising interest rates and mortgage rates, Wall Street really remains high in the stock. And we'll get to some of the mortgage rate stuff when we talk about the next stock. But despite all of that, 13 of the 19 brokerage recommendations that we have for Lowe's at the moment are strong buys, with one more buy and then nothing below a hold. So still Wall Street's really high on the stock overall and as a long-term play. The company is also part of the building products and retail industry that sits in the top 9% of over 250 Zacks sectors. So despite all of the kind of negativity in terms of the housing market going in the wrong direction as interest rates are rising, many of the companies that are within this broader industry are highly ranked Zacks stocks at the moment, which means their earnings estimates are trending higher. In terms of the stock price movement, the stock is up 570% in the past decade. This tops its industry's 400% climb and outpaces its big rival Home Depot, which is up about 515%, and well above the S&P 500's 260% run. If we look over the last 3 years, Lowe's is up about 92%. This comes against the market's 65% climb and Home Depot's 60% run. Despite that strength within the last 3 years as well, the stock has tumbled 20% from its December record, so it's currently trading around $210 per share, and it's also trading 30% below its current Zacks consensus price target, which is sitting at about $275 per share. So huge upside to its records and really big upside compared to the current Zacks consensus price target. And then in terms of valuation, Lowe's is currently trading at 15.7 times forward 12-month earnings, which marks a discount to its decade-long median of about 18 times. And if we look back over the last 5 years, it also marks a discount to its industry's average, which is nice. And if we look back over the last 5 years, it's really trading at pretty much its lowest levels. And it's traded at these levels a couple times in the last 5 years, but it's at its lowest levels besides the pandemic lows. So that 15.7 times forward 12-month earnings is a nice level, and we might see buyers step back in as the valuation looks strong, especially when you consider how the stock price has done itself. And it's been able to outpace its peers while still trading at a discount in terms of valuation. So along with that solid valuation and its falling price recently, the company is hovering near oversold RSI levels of 30 or under. It's at 33 at the moment, so you could see some near-term buyers step in soon, some traders who are looking at some of those technical indicators. And that's down from around 60 or above neutral levels just a few weeks ago. We should also note that on top of all the positives, the company is buying back its own stock. It returned about $15 billion to shareholders through repurchases and dividends in 2021. And the company plans to repurchase approximately $12 billion worth of its stock in 2022. So it's showing you its financial strength and positive outlook amid all of the broader worries. And its yield is sitting at about 1.5% at the moment. So certainly worth considering as an investor who has a longer term outlook. As I said, the volatility, especially when we've gone on such an impressive run in the last 2 weeks, we could see things turn around, reverse course maybe a little bit, given all the uncertainty and the rising interest rates. But if you're a longer term investor, Lowe's at these levels is certainly worth taking a longer look and maybe adding it to your broader portfolio. So the next of the two housing market and housing spending related stocks we're going to look at is a home builder, and that is D.R. Horton, which trades under the ticker DHI. D.R. Horton is really one of America's largest home builders with the current operations in 100 markets in 32 states. The company operates a pretty diverse portfolio of brands that includes its namesake, as well as Emerald Homes and some others. And its various brands cater to different types of buyers at different stages of life and income brackets, which is great. So D.R. Horton breaks down its offerings into first-time buyers, then quote quality and value, active adult, and luxury. So its prices range in general from around 150K to a million or more. So it really does get a broad swath. Really, the whole housing market, it fits in between those categories. So on top of that, it's in the single family and multifamily rental property business. And then unlike some of the other home builders, the company offers through various subsidiaries, mortgage financing, title services, and insurance services as well. The company posted 37% revenue growth for the full year ended on September 30th to help lift its adjusted earnings by 78%. So coming off a really, really big year. Including last year, D.R. Horton has averaged about 23% revenue growth over the last decade, with its lowest top-line expansion coming in at 10%. So even though the housing market's done really well in the last 2 years with COVID, the company has been really successful over the last decade. So 10% growth was its slowest in the last 10 years, which is really puts things into perspective. Then most recently, it posted 19% revenue growth in the first quarter of 2022. Its first quarter of 2022, with 48% higher earnings. So a really strong start to the new fiscal year as well. And then last quarter, it closed over 18,000 homes with the value up 17% to about 6.7 billion. In looking ahead, the company had roughly 55,000 homes in its inventory at the end of December, and it had started over 25,000 homes during the first quarter of 2022. And despite the slowdown, the housing market still remains relatively hot, and most importantly, reports suggest that it's still millions of single-family homes short of current demand, and these trends could continue as millennials are finally driving the housing market. And then, as I mentioned earlier, we're going to touch on a little bit more about mortgage rates. So the 30-year fixed-rate mortgage currently in the United States is averaging about 4.4%, which is at new year-long highs by far, which makes sense because the COVID lows were really low. So if we look over the last decade, this 4.4% is not the highest in the last decade. It's higher than it's been at many points in the last decade, but still pretty reasonable. And they've shot up so quickly with the rising interest rates that we could see it start to stabilize a little bit more. And then with these rising interest rates, that obviously will make the housing market a little less like massive than it was when rates were in the 2%. We are seeing now more demand where people are, if they were thinking about buying, they're going to start buying sooner to try to get in before the rates keep rising. That's sort of the logic there. And then if we look, so as we mentioned, these are still relatively in line with where we've been over the last decade. And still, if we look before that, historically very, very low, even though they've gone up from those COVID lows. So with this in mind, despite these rising interest rates in a less hot housing market, our Zacks estimates are calling for its 2022 revenue to climb another 27% from 28 billion all the way up to 35 billion, with 2023 projected to come in another 9% higher all the way up to 38 billion. So another 2 strong years on top of what's been a really great past 10 years for D.R. Horton. And then at the bottom end, its adjusted earnings are expected to surge another 38% higher this year, and then another 5% higher next year. Analysts also race to up their earnings guidance since its last quarter release in February, with its 2020 consensus estimate up about 10% since it reported. So that's a good sign. And then in terms of the company still sees positivity, and obviously the company's always going to look for the positives, but their CEO said in prepared remarks that, quote, the housing market conditions remain very robust and we're still selling homes later in the construction cycle so we can better ensure the certainty of the home close date for our home buyers. And he went on to say, we continue to focus on building the infrastructure and processes to support higher level of home starts while working to stabilize, then reduce our construction cycle times to historical norms. So amid all of the chaos of COVID and rising prices across the board and supply chain issues, they're trying to get back to completing projects more quickly, and we can see that their top and bottom line figures are showing that they're going to be able to do that pretty easily. And then in terms of the stock price, the company's shares have climbed 415% in the past decade. This doubles its industry's average, and this outperformance includes a 90% rally in the last 3 years. This comes above the benchmark S&P 500 65% climb and tops its highly ranked industry's 51%. So like with Lowe's, the stock has been suffering recently, and it's actually been a pretty wild run over the last 12 months, some big swings up and down, and it currently hovers at around $78 per share. Last time I looked, it was at $77.88 per share, which is about 30% below its December records. This also marks 55% below its current Zacks consensus price target. So its consensus price target gives 55% upside to its current level. So solid outlook there. And then on the valuation side of the coin, the stock is trading at decade-long lows at 4.8 times forward 12-month earnings, which is 80% value compared to its highs over the last decade. And once again, this is trading at new decade-long lows, even though the stock is up 415% in the past decade. This also marks great value compared to the S&P 500's 20 times forward 12-month sales, and it marks solid value compared to it's about trading about 35% discount to its industry at the moment, which is solid as well. So once again, trading at new decade-long lows at 4.8 times forward 12-month earnings, along with its stock price trading at a discount to its recent highs. So amid all of that, the company has seen some solid earnings estimate activity that helps it rank as a Zacks ranked number one strong buy. This comes alongside a B grade for value in our style score system, as we just alluded to. The company also buys back its own stock, and it has a dividend that's yielding about 1.2% at the moment. And alongside its individual strengths, the stock is part of the building products home builder space that's still in the top 23% of over 250 Zacks industries. And Wall Street is also still really pretty high on the stock, with 11 of the 15 brokerage recommendations that we have at strong buys. So despite the rising rates and higher prices across the economy, its outlook is still strong, and its valuation levels are looking really enticing at the moment if you're a longer term investor, and its balance sheet is rather strong. So both Lowe's and DR Horton are worth considering, both as a value play, as a long-term investment, as an investment on the broader growth of the U.S. housing market for years and years to come, even though we've seen a big boom off the COVID lows. So that does it for another episode of Full Court Finance. Until next time, I'm your host, Ben Rains. And remember, if you have any questions, please feel free to shoot us an email over at podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.